Yo, what's going on YouTube? It's your boy Michael, aka Mr. Drake Visions, and I am your credit CEO, back at it again with another one. You see the title, you see the thumbnail. We about to get into some crazy news. I just actually learned that mortgage applications has plummeted 60% since the pandemic. But not only that, Americans need about $115,000 to qualify for a mortgage. And I don't know many people who made $115,000 in a year. And not only that, home rates are up 80%, even if you adjust for inflation in a normal time period. Which leads me to believe that the feds have lost control of the mortgage rates altogether. And the last thing you're gonna need to make the mortgage crisis even worse is the empty homes that are out there that are not being sold. So what we're gonna do is we're gonna take a deep dive on this video so I can show you exactly what I'm talking about. Let's go.
What I'm about to show you will make the 2008 housing crash look like a minor correction. The numbers we've uncovered are not just alarming, they're unprecedented in American housing history, and they reveal a crisis that's been brewing right under everyone's nose. We are witnessing the biggest collapse in home buyer demand ever recorded in American history. But before we reveal the shocking data that proves why this housing crisis will be 100 times worse than 2008, you need to understand what's really happening beneath the surface of today's housing market. Let's start with the most alarming statistic we've seen in years of analyzing housing data. Mortgage applications have plummeted 63% from their pandemic peak. It's not just a decline, it's a complete collapse in buyer demand that dwarfs anything we saw in 2008. And here's why this matters so much. Even during the worst of the 2008 crash, we never saw demand destruction at this level.
Okay, let me tell you what's the difference between this and that. In 2008, people were claiming income that they didn't have. But now people have the money, but in order for somebody who bought during the pandemic to move, they will have to automatically have a higher interest rate. Let me explain. Interest rates were as low because I fixed people credit and I was helping them get houses. And my lender was getting people 2.5% interest rates for 30 years. My dad got one of those rates. For him to move, my dad, $100,000 house, for him to move, he will have to get another house, same value, but pay almost double a month because of the interest rate difference. You see what I'm saying? So people who are locked in with their interest rate, they can't move because they will have to buy less of a house and pay almost the same or even more if they do it. That equity that they got locked up in their house. So my dad bought his house for $100,000, right? And one of his houses for $100,000. It's worth 180 right now. But nobody's going to pay 180 for what he got because if they got a house at 180, it's bigger than the house that he's selling. So I'm assuming that's happening across the board.
But that's just the beginning. Let me show you something that should terrify every economist in America. This graph shows the annual income needed to buy a median-priced home in America today. What you're looking at is a spike that's completely disconnected from reality. Americans now need to earn $115,000 just to qualify for a basic mortgage. This isn't just a record, it's a mathematical impossibility for the vast majority of American households. Now, let me explain why this situation is fundamentally different and far more dangerous than 2008. We're experiencing the perfect storm of three factors that have never converged in housing market history. First, we're seeing the highest inflation-adjusted home prices, not just since 2008, but in 134 years of recorded American housing history. When we adjust for inflation going all the way back to 1890, today's home prices are 80% above the long-term historical norm. Even at the peak of the 2008 bubble, we never saw prices this disconnected from reality. Second, mortgage rates are stuck above 7% with no relief in sight. Here's where it gets really concerning. The Federal Reserve has completely lost control of the housing market. Let me prove this to you. In September, the Fed started cutting rates. Logic would suggest mortgage rates should have dropped. Instead, something unprecedented happened. Mortgage rates shot up to 7.26%. It's not supposed to happen. It's as if the Fed has lost its grip on the market entirely. Third, and most crucially, we're seeing a fundamental shift in market psychology that's far more severe than anything we experienced in 2008. According to the latest Fannie Mae survey, 78% of Americans think it's a bad time to buy, the highest negative sentiment ever recorded. To put this in perspective, even during the depths of the 2008 crash, 72% of Americans thought it was a good time to buy. We've never seen this level of market rejection before. Let me show you how this is playing out in real time across America's largest housing markets. In Florida, we're seeing something unprecedented. Homes are now sitting on the market for 79 days, the highest level in a decade.
See, in Florida is weird because I'm here and I was thinking about buying a house in Florida, but the insurance that you have to pay for the houses in Florida is absolutely going through the roof. Even the car insurance is up, the housing insurance is up. I think one of the big insurance players had they rolled out of Florida, so now it's like the Wild Wild West, and they're just charging whatever they can when they can because they know you got to have it. Ain't nobody like on top of it. Now, the only way I think we can make it out of this is if single family buyers get like a large credit. That way we keep the big corporations out of the home buying process, because I believe that, I'm not going to say 50%, maybe 20 to 25% of houses, single family homes, are owned by banks and people are renting them, like I'm renting this one.
The pandemic boom, this number was just 55 days. This explosion in days on market isn't just a statistic. It's a clear signal that the market is starting to crack. Texas, which many considered immune to housing downturns, is showing serious signs of stress. Inventory has exploded to 155,000 homes, the highest January month level in 7 years. This surge in inventory isn't just about more sellers, it's about buyers disappearing from the market entirely. The mountain states, particularly Colorado, are exhibiting warning signs that nobody's talking about. The market has shifted so dramatically that builders are starting to halt new projects, something we haven't seen since the last crash. But to truly understand why this situation is 100 times worse than 2008, we need to look at the historical context. We want to show you a chart that very few people have seen. This graph tracks inflation-adjusted home prices going back to 1890. What you're about to see is shocking. For over 100 years, from 1890 to 1997, home prices stayed relatively flat when adjusted for inflation. Then something changed. We entered a period of unprecedented price appreciation that makes the 2008 bubble look tiny in comparison. Today's prices aren't just high, they're 80% above the long-term historical norm when adjusted for inflation. This is mathematical proof that we're in the biggest housing bubble in American history. The psychology of today's market is fundamentally different from 2008, and that's what makes this situation so much more dangerous. In 2008, we had a subprime mortgage crisis. People who couldn't afford their homes were forced out. Today, we're seeing something far more concerning. Qualified buyers are simply refusing to participate in the market. Let me show you exactly how severe this buyer strike has been. Current mortgage application numbers tell a story that's almost hard to believe. Applications aren't just down slightly, they've fallen off a cliff.
Because, man, nobody will want to leave their home to purchase a worse home for more money. And that's what it comes down to. Because realistically, your money doesn't go as far as it used to. And in 2008, people was just lying about the income. It was a foreclosure crisis, but now it's an inventory crisis along with a rate crisis along with human psychology, to where people don't want to move because, hey man, I might as well stay where I'm at. But then, some people are getting laid off. So now these houses are vacant because they were building towards growth. And then the growth, like everything halted because these people that got the new houses that would normally move out in 5 years, they're not moving.
They're down 14% from 2024, a stunning 54% from 2022, and even 52% from pre-pandemic 2020 levels. This is what a complete collapse in demand looks like. Here's why this crisis is fundamentally different and more severe than 2008. Let me show you the math that nobody else is talking about. When we look at a typical home purchase today versus just a few years ago, the numbers are staggering. A $400,000 home in 2019 with a 3.5% mortgage rate would have a monthly payment of $1,796. That same home today, now priced at $500,000.
You see how it says 500,000 at 7.2, but the price is almost double and it's only $100,000 in equity. Y'all see that? You see how it works? That's why it's crazy out here. But I know my viewers are, smarter than that. We getting homes we can't afford. We growing that equity, and then we're gonna keep that house, and we're gonna save our money and invest it the right way.
With a 7.26% rate requires a monthly payment of $3,416. That's a huge increase in monthly payments in just a few years. But here's what makes this truly unprecedented. A 7% mortgage rate isn't historically unusual. In fact, if we look back at mortgage rates from 1890 to 1964, today's rates are only slightly above historical norms. What's not normal, what's never happened before in American history, is having 7% rates combined with the most inflated home prices we've ever seen. The data shows price cuts are already spreading across the country, and they're accelerating in a way that suggests this is just the beginning. We're now seeing year-over-year price declines in about 50% of states, something that simply didn't happen in the lead up to 2008. The price cuts are starting at the high end of the market and working their way down, exactly the pattern we see at the beginning of major market corrections. Manhattan is already showing some weakness, with luxury properties leading the decline. California is seeing increasing pressure on prices, particularly in premium areas. Even Miami, which many consider immune due to cash buyers, is showing cracks in its market with dramatic increases in days on market and growing inventory. Here's why the coming correction will be fundamentally different from 2008. In the last crash, we could fix the problem by addressing bad lending practices and lowering interest rates. Today, we're facing a basic affordability crisis that can't be solved with typical policy tools. The Fed is essentially trapped. If they cut rates aggressively to help housing, they risk reigniting inflation. If they keep rates high, they risk a housing market collapse. This is why we're seeing something unprecedented. The Fed cutting rates while mortgage rates actually increase. The bond market is essentially saying it doesn't believe the Fed can control inflation without keeping rates high. For anyone thinking about buying or investing in real estate, this data leads to some clear conclusions.
Hey man, that's some nice yards, I ain't gonna lie. What I think needs to happen is it's gonna have to be some type of policy put in place. It might hurt for a little bit for the average American who's buying houses to rent, but I think something got to be done with these companies buying houses, because these companies are buying houses over asking price, over $100,000 asking, because they know, or they got the deep pockets to do it. So they're buying the houses. They're buying the houses all right. They're paying for bare minimum insurance because they're in bed with them, and then they're renting the houses out. And then they're renting the houses out with the intentions to sell within 5 to 10 years. So if the housing market keeps going up and they keep buying, they are manufacturing inflation. If you got 5 houses on the block and they're all 5 of them $100,000 a piece. If some type of big company come in and buy each one of those houses at $200,000, not the whole neighborhood, but a block in a 3-mile radius, they're going to use that as comps. And now that house is going to be worth that. So they don't care. They just manipulate the market.
First, don't expect significant mortgage rate relief in 2025. The market is telling us rates will likely stay between 6.5% and 7.5% unless we see a major economic downturn. Second, any improvement in affordability will have to come from price declines. With wages growing at only 4 to 5% annually, it would take years for incomes to catch up to current price levels. The math simply doesn't work anymore. Let's dive deeper into what's happening across specific regions, because this crisis isn't hitting all markets equally. Florida, which many considered a bulletproof market due to migration patterns, is showing serious signs of stress. Beyond the 79-day average time on market I mentioned earlier, we're seeing something even more concerning. Open houses in premium areas are sitting completely empty. This isn't just anecdotal, it's a measurable trend that's accelerating. In Texas, the situation is particularly alarming because it challenges everything we thought we knew about strong housing markets. Texas was supposed to be immune to housing crashes due to its business-friendly environment and population growth. But here's what's actually happening. The massive inventory surge to 155,000 homes isn't just about more sellers, it's about a fundamental shift in buying patterns. New construction homes, which were selling before completion during the pandemic, are now sitting empty for months. Here's where things get really concerning. We're entering what we call an affordability death spiral. Here's how it works. High prices and high rates create low demand. Low demand leads to homes sitting on the market longer. Longer market times force price cuts, but because rates are so high, even significant price cuts aren't enough to bring monthly payments down to affordable levels. Let me show you this mathematically. Even if home prices dropped 10% from current levels, with rates at 7.26%, monthly payments would still be higher than they were at peak prices in 2022 when rates were lower. This creates a vicious cycle that can only be broken by either a massive drop in home prices or a significant decline in mortgage rates. And as we've seen, the Fed seems to have lost its ability to influence rates effectively. There's another factor that virtually no one is talking about: the hidden weakness in the luxury market. High-end homes, particularly in coastal markets, are seeing price cuts that aren't fully reflected in median price data. This is crucial because historically, major housing corrections often start at the high end and work their way down to the broader market. In places like Los Angeles and New York, we're seeing luxury properties sit on the market for unprecedented periods, often with multiple price cuts before selling. This pattern precisely mirrors what we saw in 2006 and 2007.
It's probably because you can't sell $1 million house for $3 million. The person who got $1 million, like, hey, who else gonna buy it besides me? I'm 0.001%. So let it sit there. I'm gonna put in my price at $1 million, and then you're gonna have to either try to sell it or keep lowering that price until I get what I want. But the average person is like starving to buy a house. Millionaires aren't.
Right before the last major housing correction. Adding to these pressures is a demographic shift that's about to hit the market. The largest cohort of baby boomers is approaching an age where historically, homeowners begin to sell and downsize. This could flood the market with additional inventory just as demand is collapsing. We're looking at potentially millions of homes coming to market over the next decade, hitting right as affordability is at its worst levels in history. As we wrap up this analysis, it's crucial to understand that what we're witnessing isn't just another housing cycle. It's the culmination of decades of policy mistakes and market distortions. The combination of record high prices, stubbornly high rates, collapsing demand, and shifting demographics has created conditions we've never seen before in American housing market history. This isn't about fear-mongering, it's about understanding the reality of our current situation. The biggest housing market correction in American history isn't just possible. Based on the data we've reviewed, it's becoming increasingly probable. The math simply doesn't work anymore, and when markets reach points where the math doesn't work, corrections aren't just likely, they're inevitable. If you found this analysis valuable, make sure to like this video and subscribe to stay updated as this situation continues to develop. We'll be tracking these trends and providing regular updates as new data becomes available. Hit that notification bell to ensure you don't miss any of our upcoming market analysis videos. Remember, understanding these market dynamics isn't just about protecting yourself. It's about being prepared for whatever opportunities might arise from this historic market shift. Stay informed, stay prepared, and most importantly, make sure you understand your local market conditions before making any major housing decisions in 2025.
Big screen. Hey man, so what y'all think, man? Hey, what y'all got for me? Because I know y'all got the good interest rate, man. Don't buy in this market because it's going to get crazy. Just wait for the crash to happen. Save as much money as possible. That's what I'm doing. I'm trying to save a lot of money each month. I'm downsizing everything, and I'm just waiting for the eventual crash. Like I said in the video, I'm buying houses cash, and I'm sticking to my morals and my strategies. Ain't nobody gonna move me off my square. But YouTube is gonna suggest that you subscribe to the channel. I highly suggest you to subscribe to the channel for more content like this, and it's gonna suggest another video for you to watch right here because they think you will like it. So without further ado, thank you guys for watching the video all the way through. Credit CEOs, we out of here. Peace.